Debt Verdict, DV026. Title, Lehman Brothers, The Day Wall Street Collapsed. Formula expose, duration 15 min, 1800 words. On September 15, 2008, at 1:45 in the morning, Lehman Brothers Holdings filed for Chapter 11 bankruptcy. $613 billion in debt, $639 billion in assets. It was the largest bankruptcy filing in the history of the United States, and what followed was a financial earthquake that shook every corner of the planet. This is the story of how one bank's greed brought the global economy to its knees, and how the people who caused it walked away with hundreds of millions of dollars. Lehman Brothers was founded in 1850 by Henry Lehman, a German immigrant who started with a dry goods store in Montgomery, Alabama. Over the next century and a half, it grew into one of the most powerful investment banks in the world. By the early 2000s, Lehman was a Wall Street titan. It had survived the Civil War, 2 world wars, the Great Depression, and the dot-com crash. It employed over 25,000 people across 40 countries. At the helm was Richard Dick Fuld Jr., a man known on Wall Street as the Gorilla. He had been CEO since 1994, and under his leadership, Lehman's stock price had risen over 600%. Fuld was worth an estimated $1 billion. He had a $14 million Park Avenue apartment, a $21 million estate in Greenwich, Connecticut, and the kind of reputation that made people on trading floors go quiet when he walked past. But behind the prestige, behind the $60 billion in annual revenues, something was rotting, and it had everything to do with the American dream of home ownership. In the years leading up to 2008, the American housing market was on fire. Home prices were climbing, banks were issuing mortgages at a furious pace, and Wall Street had figured out a way to turn those mortgages into gold. The trick was called mortgage-backed securities. Banks would bundle thousands of mortgages together, slice them into tranches, and sell them to investors around the world. The riskier the mortgage, the higher the return. Rating agencies like Moody's and Standard & Poor's stamped them with AAA ratings, the highest possible grade, and Lehman Brothers was all in. Under Dick Fuld, Lehman became one of the largest underwriters of subprime mortgages in the country. They weren't just packaging other people's risk. They were buying it, holding it, betting the entire firm on the idea that American home prices would never go down. By 2007, Lehman held $111 billion in commercial and residential real estate assets. Their leverage ratio was 31-1, meaning for every dollar of actual capital, they had $31 of borrowed money at risk. That's not investing, that's gambling, and the house was about to lose. In the summer of 2007, 2 hedge funds at Bear Stearns collapsed because of subprime exposure. It was a warning shot. Lehman's stock started dropping. Internally, some executives began raising alarms, but Dick Fuld wouldn't listen. Former Lehman VP Lawrence McDonald later wrote in his book, A Colossal Failure of Common Sense, that Fuld was surrounded by yes-men who told him what he wanted to hear. In March 2008, Bear Stearns collapsed entirely and was absorbed by J.P. Morgan Chase in an emergency deal backed by the Federal Reserve. The dominoes were falling. Lehman reported a $2.8 billion loss in Q2 of 2008, its first quarterly loss in 14 years. The stock plummeted 73%. Behind closed doors, Fuld tried desperately to find a buyer. He approached Warren Buffett. Buffett passed. He talked to the Korea Development Bank. They walked away. Barclays showed interest. The British government blocked the deal. Meanwhile, Lehman was using an accounting trick called Repo 105, temporarily moving $50 billion in assets off its balance sheet before quarterly reports to make its financial position look healthier than it was. The SEC and the Federal Reserve knew, and they did nothing. Climax. On the weekend of September 13-14, 2008, Treasury Secretary Hank Paulson and Federal Reserve Chairman Ben Bernanke gathered the CEOs of the biggest banks in America at the New York Federal Reserve Building. The message was blunt. The government was not going to bail out Lehman Brothers. The banks needed to figure this out among themselves. They couldn't. At 1:45 a.m. on Monday, September 15th, Lehman Brothers filed for bankruptcy. Its 25,000 employees arrived at the firm's 7th Avenue headquarters that morning carrying boxes. Photographers captured them walking out the doors, their careers and retirement savings vaporized. The Dow Jones fell 504 points that day, its largest single-day drop since September 11, 2001. But that was just the beginning. Within 48 hours, AIG, the world's largest insurance company, was on the brink of collapse because it had insured billions in Lehman's toxic assets. The government intervened with an $85 billion bailout, then $67 billion more, then $40 billion more. The money market fund reserve primary fund broke the buck for only the second time in history because it held $785 million in Lehman debt. Investors panicked. Credit markets froze globally. In Iceland, all three major banks collapsed within a week. In the UK, the government nationalized Northern Rock and Royal Bank of Scotland. In Ireland, the entire banking system required a government guarantee. The contagion was global, instantaneous, and devastating. The numbers are staggering. 8.7 million Americans lost their jobs between 2007 and 2010. Unemployment peaked at 10% in October 2009. Nearly 10 million families lost their homes to foreclosure. In cities like Detroit, Las Vegas, and Phoenix, entire neighborhoods were gutted. Houses that sold for $300,000 in 2006 were worth $100,000 by 2009. American households lost approximately $16 trillion in net worth between June 2007 and March 2009, according to the Federal Reserve. Retirement savings were decimated. The average 401k lost 31% of its value in 2008. People who were months from retirement found themselves